Okay, so in this video we will take a look at a liquidity and volume, and I will also recap some things from the last one, so we are all clear with everything I talked about so far. So once again, these are just kind of a fundamental understandings which are extremely important, because understanding these concepts will give you foundation of the kind of essential edge, as you'll be able to understand what markets are trying to do and how prices are responding to these kind of underlying efforts. So the order book is something I have covered in the last lesson, but let's actually give this one more look. The order book is also called depth of market, or DOM, and it shows resting orders at each price levels. What you see on this slide right now is DOM for 10-year German Bund. Before going in depth, there is worth saying that for something like crypto or other really thin markets, you probably won't be using this that much. I have found out DOM useful in thick markets such as bonds or maybe ES, but any markets that are just too fast, it can cause you more harm than good. But this doesn't change the fact that this is still good to understand these things. So in the blue and red columns you have a limit orders. Blue columns show demand, which are bids, and the red columns show offers, which are supply in the markets. As you can see, this market is currently sitting at 169.96. So for this market to move one tick to 97, someone has to buy those 23 lots which are resting there. Like I said, it doesn't matter if this will be one person buying 23 lots or 23 people buying one lot. The column between the bid and ask, which is this one right here, is showing you how many contracts were actually executed in those prices. This is an important thing to understand, that all limit orders that are in the book are just the advertisement. Anyone can place them there, and this usually is the fallacy. And you see this lot in crypto, where people post very frequently these heat map charts with resting orders in them, because let's say that you are a large trader in the Bund and you trade 1000 lots. If you want to buy 10 tick below the current price, so you want to buy here at 86s, does it really make sense for you to just slap that 1000 lot there? If you do that, there is a high likelihood that people will just start front running you and buying above the order to create the momentum of this kind of a wall being resting there. I already mentioned the spoofing, which obviously would mean that the person would just place that 1000 lot in a book, which would start more people aggressively buying, anticipating to move higher, but the same person would be just filling the sell side here, and once he filled up his inventory, he will just pull the order. The buy wall is gone now, and market will just flush down through it, with him being on the side he actually wanted to be. So that's it. For the DOM, like I said, it can be kind of terrifying at first, but it's really a simple way to see orders in the market. These things here, like I said, these are the pooled and stacked orders. And what is important to understand, that larger players are using this patient approach with limit orders, and the market orders are usually used by a smaller retail traders to get in quickly and out, because they don't mind paying a spread. So the understanding of liquidity is, as you already know, the liquidity is representing the resting orders in the market. These bids and these offers are what is called liquidity in the market. The picture on the slide is kind of a pretty nice demonstration of things that I mentioned already, which, as you can see, there is this kind of a sell wall resting here, but the second market is going to to get through it, it will just disappear. The market will spike higher. One thing that is not visible in the order book are stop orders. So if you see someone pointing out the heat maps or chart with resting orders telling you there are stopped, it's not true. You cannot see them in the books. This is kind of an important thing to understand. So because people then talk about the resting stops in the market and strategies that involve stop hunting or these false breakouts and so on and so forth, but although this is not a complicated to kind of understand where stops are resting, as most retail traders put them beyond key swing points, double bottoms, double tops, daily swing highs and swing lows. You can only say that stops were taken after the event, which I show you later on when we will be talking about the order flow. Sometimes market break the new high or low and simply lose the momentum due to the traders who are anticipating that breakout just start taking profits. So the important takeaway from it is that not every move beyond a certain point is a stop run. There is nothing false in a false break. It's just how markets are actually moving. The important thing you should be taking away from this is that these levels are bringing a participation, and where other people are trading, you want to be trading as well, because obviously that will bring you some of the opportunity. So another concept tied to liquidity are liquidity gaps. You will hear much more about these further on, but there are names used for these, and you might heard something like liquidity gap, low volume node, single print, the fair value gap, and so on. These are essentially the same things, and the liquidity gaps happen when there is a large imbalance in supply and demand, as for every seller there has to be a buyer and vice versa, which I covered in the section about the DOMs, how you need a counterparty for each trade. When one side becomes really dominant, market just spikes through all available liquidity. So for example, if some aggressive buyers would step in here and they will just be buying throughout all these offers, market would just quickly spike through them. Also, during some unexpected events, these orders will just get quickly pulled and market will just really move quickly through the levels. So there are different types of gaps and different kind of situations where these happen. So the most kind of a popular one are the common gaps, which happen when the market is consolidating in a tight range. Let me actually draw this one for you. When markets are consolidating in a tight ranges, the gap is created, which is right here, and then market, once it pulls back into the gap and hits the tight range, it will continue its direction higher. So this continuation then happens for basically two reasons. The first one is that those that trade with a size and kind of initiated the move are not often able to execute the whole size at the level. So for example, if you had some large buyers here in this area, they didn't completely they are not completely done with their buying. So once market pulls back, they have the resting buy orders in the level, and markets will proceed to go up. this is called a order stacking. You know, the orders get stacked at these levels, so when markets revisit these kind of a obvious areas, they will continue higher. The second reason is that there are traders who got caught on the opposite side and they will start covering their trade. So obviously if you were shorting this, you know, and you wouldn't believe how many people are not using any kind of stop losses or anything, once market pulls back into the level, you know, they will get the opportunity to cover their shorts. And obviously if you have a short and you will cover it, you know, you are basically longing, so this will create more momentum to the upside. The runaway gaps are the second type, which also happen, are caused by these supply and demand imbalances, but the momentum is simply too strong, which will actually result in price not even coming back. And you know, so market will do this first leg, then it will kind of consolidate for a little bit, and then it will just continue to the direction of the move. You know, these are not easy to trade. There are some ways, if you start executing them on lower time frames, I will show you some ways how to get into these trends, but you know, very often you will have very little time to actually jump into the move when there is something like a runaway gap. And the last one is the exhaustion gap, and this is actually where there is a liquidity gap at the end of the trend. What happens is the supply and demand imbalance is created, and market orders are just rushing to buy it, but there is something in a way, which is, you know, the limit orders consuming this buying created from the momentum, and there is no intention from these people to continue in the move. So basically how this looks is this market will make a move, this huge move to the upside, but it will move into some sort of a higher time frame key resistance. And what you will very often see is that huge market buying happening at the high. This is kind of your signal that it's not the best idea to go bid here, because you will have just market orders buying here, but it will all get consumed by the limit orders above the market, and then these markets will just roll over and sell off, which is one of the strategies that I will be covering a little bit later on. The last thing about the liquidity is these liquidation cascades. These happen in crypto very often during the large sell-offs. Obviously, market will just, you know, aggressively going down, and like I said, if you are long and your stop gets hit, it gets covered to the short order. So basically markets, let me just once again demonstrate this. You will have basically any sort of kind of a key support level where everyone is just placing their stops below that. Just draw this once again, and once market kind of goes down to it, all these stops, you know, are getting triggered, which will just kind of it's just too many of them, so the market will just kind of cascade to the downside. And you know, because there is not enough a counterparty for it and no one just wants to buy it, and all these liquidations are just kind of driving prices lower. These are you know, often thing in crypto. Like I said, there is no counterpart. This looks very scary, but there are usually a good opportunity to actually buy. So how volume and liquidity influence? influence the markets. So there are four situations basically where you can four conditions which you will find out markets trading. There is a high volume and low liquidity. This is signaled by a high volatility because the order books are really thin. There is not many bids and offers resting in the market, but there is a high large amount of aggressive market buyers and market sellers. So this is when is resulted in a high volatility. This often leads to large moves in price and also flash crashes when liquidity is only provided by HFT algorithms. High volume and high liquidity and low volume and low liquidity are signals of moderate amount of volatility. This is basically kind of a equal situation, pretty much like markets like these bonds are usually kind of a case of this, even though these are a little bit slower. But when the amount of market orders and the liquidity in the books is more of a equal during any kind of a standard trading day, there is a market will just kind of a slowly move to the one side. And when it's a low volume and high liquidity, there is a low volatility because the books are well populated, but no one wants to do the counterparty. If I draw this as an example, let me just do this. So if you have a market which is kind of doing something like this, then it's going to do something like this, and then it's also going to do something like this. You can separate these things into three kind of scenarios. Basically, you have a liquidity and you have also a volume. So for this case where liquidity is where markets are just moving in a very tight range, there is a high liquidity because, like I said, the books are very populated and there is a very low volume because no one is executing these orders in the book. So this will result in those very tight ranges in the markets. Once markets start to move and they will fluctuate a little bit more, the liquidity and the volume is basically moderate. It's kind of a medium. The resting orders are finding often a counterparty, so market is just kind of moving to the one side or the other. And once there is this huge spike in the market, this means that there is a low liquidity and high volume. Okay, so once again, not many orders are in the book, but there is a lot of kind of a incentive to buy or sell the market. So this is a high, but this is quite low. So this for a volume and liquidity, and this is once again good thing to understand because you will kind of be able to determine the conditions you are currently in. The last thing in this one is a volume relativity, which the volume is the amount of finalized orders that are executed. There are different types of indicators that will show you the relative volume. The most popular is a R-vol. I will show you this when we will be taking a look at different platforms and stuff like that. But you have a higher relative volume which dictate price movements and can be spotted at breakouts or end of the moves, and you have a low relative volume that is shown as just kind of a lack of participation, and you can see that as a kind of a liquidity gaps that gets filled later on. So for example, these blue and purple candles show the high relative volumes and the yellow ones show the low relative volume. So you can see how this move higher, or you know, kind of this move right here started on a low relative volume, it gets immediately filled back, you know, gets filled here, this one gets filled here, then the market moves higher, the volume is picking up, and at the end of this kind of a rotation, you know, you have a higher relative volume that marks out the top, because you know you have a market orders just chasing the breakout, the limits filling the other side, and market will just kind of sell off, and then you have a large relative volume picking to the sell side, which will drive this market lower. So this is going to be it for this one. Let's jump to another one.